Our next guest says inflation in services remains the biggest risk to interest rate cuts. To break it down for us, Michelle Cluver, Global Senior Portfolio Strategist, joins us this morning. Michelle, good to talk to you today. When you look at where those services inflation came in, up 0.7% in January compared to the 0.4% in December, a big chunk of that was in real estate. To what extent has that changed your outlook on the Fed, or where you think the Fed is going to move?
It hasn't changed my trajectory or views on it yet. Obviously, one hot data print doesn't make a trend. Also, with it being January data, this can be impacted by some more seasonality factors. But we are certainly keeping an eye on future inflation prints because we really do want to see disinflation moving into the services areas and particularly into that shelter component that you mentioned.
So is service inflation is that what's going to be that makes or breaks this ability to get down to that 2% target and finally get inflation off the Fed's back?
I fully believe that. We've been seeing really good disinflation in the goods areas, but the services areas remain too hot. And if we think about concerns about wage price and spirals, that's really in the services area. And so from the sustainability of the inflation trend, getting that disinflation into services is key. And thinking about the FOMC minutes from the January meeting, there was a lot of focus on what the Fed was saying in terms of both level as well as trend. And I believe that they really focused on seeing an improving trend and that the sustainability of that trend.
With that said, Michelle, let's talk about what we've been seeing in earnings results so far. We were talking earlier about Goldman upgrading at least its year-end target on the S&P 500 on the back of positive profit outlook that we've seen from companies so far. How have you shifted up your portfolio as a result of what we've heard from companies at all, or have you at all?
So it's difficult for me to talk about moves that we're potentially planning, but at the same time, from a broader views perspective, what we're seeing currently is very favorable for equities versus fixed income. When we're thinking about a robust economy, but the risk that the Fed may have to be delayed further into the year, that talks to an environment that's supportive to more cyclical areas versus areas that are sensitive to yields.
So how aggressive do you think the Fed is going to have to be if, by some estimates, we're potentially looking at a June rate cut or later?
I think June is potentially still on the table. Obviously, it fully depends on the trajectory of inflation and if we do see those encouraging trends. Additionally, with the June FOMC meeting, that's when we're going to get the updated projections as well as getting an updated dot plot. And so those are a lot of information that can really give investors a lot of insight into the expected trajectory for those rate cuts. There's going to be a lot of focus on any data point leading up to that. And so we could see some interest rate volatility coming into that period.
And speaking of other things that we're tracking in terms of volatility, obviously we're going to have NVIDIA earnings coming out. For people who are seeing some of these market moving events that are coming up ahead, how are you advising clients to really, I guess, gauge the situation so that they're not tempted to panic sell or panic buy?
Yes, so definitely diversification is extremely important. If we think about the year that was last year, diversification didn't work great that year, but we believe that diversification is going to become even more important into this coming year. And that's an important element to ensure that investors don't panic buy or panic sell. We do think that market breadth needs to improve. We have had a very concentrated rally thus far this year. Obviously, everything's waiting on the Fed, and that has been a factor that's impacted on the concentrated nature of the rally. But we are likely to see that starting to broaden out as we go through this year. But also different areas of the market are really important as we're thinking about how to actually position for this current environment.
And just quickly, some of the other areas of the market that you think people should be paying attention to?
So with the more robust consumer activity, industrials is a key area that can stand up better as the economy remains strong. Conversely, we're becoming a lot more cautious on areas such as utilities that are more bond proxy-like and do stand to detract from when the yields, if they do get pushed out longer and the economy remains robust for longer than expected.
I appreciate you joining us with your insights. Michelle Cluver there, thank you so much for joining us this morning.
Thank you very much.